If you think you had a tough week at work, imagine what it was like to be a stock trader in one of the most volatile markets in years. Better yet, don't imagine.
How hectic do you reckon it is understanding the financial world? Welcome, ladies and gentlemen. This is our new podcast. We're starting a new podcast called Between Bears and Bulls, where we will be discussing about the financial world, all the things that happen in the stock market, real estate, forex, bonds, treasure rate, etc. With me today, I have Professor Everton Thompson, and I have Yinka Majekodumi.
Good job. There you go. You get an A for that. Yeah. Professor Thompson. I teach business classes here at the university. Many of them are entrepreneurial kind of classes, management classes, strategy classes here at the university. And so I'm looking forward to the conversation today.
Thank you. And Yinka, if you could introduce yourself to us, please.
Yinka Majekodumi. I am a CPA with expertise in both financial management and investment. I have a role in county government as a commission auditor of Miami-Dade County, and I also provide services to businesses and startups from the community and overall broad spectrum of entries, early stage companies to give CFO services.
Awesome. And if I may start, or if I may be so bold to start this podcast, a quick question is, what would you say are some good ways to begin learning about the matters of finance and being responsible with one's own finance?
I'll start by saying the best way to start is use the basics without getting into complex strategies. Just start with the basics of what discipline looks like, what financial discipline looks like, and then, assessing what opportunities you have as far as access to information, basic information. I don't believe it's prudent for people to try to learn the most complex strategies early on when you're trying to invest. You should start with the basic fundamentals of understanding your budget first and trying to improve your credit and having a savings plan and knowing what to do when you get to your savings plan and how to invest portions of your savings. I think those are just the basic to start with. I know a lot of people are normally interested in complex investment strategies, day trading strategies. I don't think that's the foundation of financial management.
Okay. And Professor Thompson, if I may get your input on this?
One of the things that I talk with the students about, and you've been in my classes, so you know, I know a lot of the students have opportunities today like they've never had before. Students can actually start businesses today. With the internet and with the social media, they can become entrepreneurs today. And if they're able to find their passions and what they're interested in, what they love, able to help people, then, as you know, I've always said, you found your purpose in life. Mm-hmm. And once you've found your purpose in life, let the world know about it and network, and then you'll get capital. Well, this is the part where I can't move forward, right? The students need to understand, how do you acquire capital? How do you invest the money when you start getting income in? As I told you earlier, if I knew now if I knew then what I know now, I would be like, me and be hanging out with some of the, the Bill Gates of the world. I think I told you, I remember when condos on Ocean Drive were $90,000 to buy the whole condominium building. But there's lots of mistakes that people make at the beginning of life with their finances, with their credit. So it makes total sense that where I talk to them about management skills and entrepreneurship and management and starting your business and all that stuff, it only makes sense that the next phase is for them to understand, well, how to invest, how to make money, how are you going to get capital. And so that's why this is important, especially for those folks that in the future, they're either going to work for somebody, partner with somebody, or start something themselves. All three of them have their benefits. So. Okay,
and on that topic, for both of you, because this is, I've heard, there are different ways to invest. You have matters. The most common matter that a lot of people my age here is stocks. But then when you kind of dive into it, okay, you have stocks, but then you have options. You can buy the stocks individually, right? You can buy swaps, etc. And then above that, you have forex, right, where you can do the futures market, the spot market. You have precious metals. You have people who like to trade, if I remember correctly, also in specific sectors too. There are people who specialize in trading in the medical sector. There are people who specialize in trading stocks that are like blue chip stocks, etc., or penny stocks. So if we could cover a little bit the different forms of investing and what are some beginner-friendly manners for new investors.
Yeah, I think that's a very good point. And like I said earlier, I think the foundational tool, when you say beginners, the foundational tools is very important because you've never seen a commercial where someone is trying to teach you how to do brain surgery on yourself, right? Mm-hmm. You may see someone giving you tips on eat well, exercise, and the foundational basics of health. Mm-hmm. So in this scenario, before we get into the brain surgery side, because you wouldn't want to perform brain surgery on yourself, right? You go to the doctor for that. Mm-hmm. So there's aspects of investing that's really up to a professional, right? You need a professional to assist you through those complicated strategies unless you're fully dedicated to it. So for the purpose of this conversation, I'll talk about just a regular person, mm-hmm. regular individual who wants to invest, not an institution, not a school endowment, nothing, just an individual. You have options because you have access right now through technology. And so whether your purpose is to get involved in stocks, bond, ETFs, you mentioned futures, those are a little bit slightly more complicated than stocks, but you have futures, you have swaps, you have forex. You get into those alternatives type complex transactions that you need to know a little bit more about the sector, right? Mm-hmm. You made a very good point about materials. Like some people have interest in gold, precious metals. Those require a little bit industry-specific knowledge, unless you're delegating to somebody else. Mm-hmm. So I may not dive too much into that just for the purpose of this. I'll start with the basics of what do we know. I think Professor Thompson said something earlier that's very important. Things that you use on a day-to-day basis, brands that you wear on a day-to-day basis, could be a good starting point. Like you wear this brand, maybe you should check if they're publicly traded and see what the stock price is, just to start. You don't have to buy anything. Mm-hmm. You just download one of the apps, and there's a lot of the apps. I'm not going to plug in any apps in this conversation, but you have the different apps of the world just to check the stock price of that specific brand that you buy and decide if it's worth your time to invest in it. Keep in mind, even that action of buying a stock, an individual stock, is risky, right? Mm-hmm. So for people who just want to start, you could start with that because you have an incentive. You wear the brand, you know the brand well, and you may not yet know how to make use of fundamentals, right? But financial experts get into fundamentals. They look at the balance sheet, they look at the income statement, the cash flow. Mm-hmm. There's a lot of layers to invest in. So I'll start, the first layer is just understanding what information you have access to based on the technology platform. The first easy thing, if you're interested, is just to learn the market itself. Go on there, find a brand that you like, learn about it a little bit, see what the price looks like, and ask questions to professionals. Mm-hmm. Now, with that said, it could be as simple as starting with a $5 investment, or it could be as complex as you just delegating it, because I want to make sure I say everybody doesn't have to be an active investor. You don't have to be an active participant. You could delegate it. You could be a passive participant because you could buy ETFs and let the professionals who manage those funds distribute your risk across different stocks, and you sit back and you do whatever you do best. You could be a photographer, a dancer, an accountant, whatever you do best, you focus on. So from my perspective, I think whoever wants to invest could start by just understanding what information is available on all these platforms. And when you do that, you could pick what path works for you best, whether you want to be an active person or you want to be a passive person. And then, you commit resources, and that's where it gets a little bit more detailed, when you have to start committing your resources to the process.
Yeah, I mentioned also earlier, once you invest at some point, it could be small, it could be 1 share or 2 share, or if you decide just to put it into a fund, it doesn't really matter. But what I was telling the students the other day, what does that make you once you've invested in the stock market? It actually makes you an owner. It really does. You may not be a majority owner,
Right.
You're a minor owner, but you have literally you have the same rights as people that have larger shares. They have to share their financial information. They have to share the directions of the company, especially if it's something you're interested in, industry that you're interested in. You're getting all this knowledge on where companies are going, businesses are going, especially if it's an area you plan to work in, an area you plan to start a business in. Let's say, I have friends that told me, hey, I'm going to be a chef. I'm going to open a restaurant. Hey, I don't want to plug any restaurants right now, but I'm sure there's some restaurant chains out there that you can publicly buy, and just follow, and they'll give you information on where it's going, where the industry is going, and all that kind of stuff. So you're an owner, and it makes you feel a little different. Literally, at the age of 20, you are an owner in corporate America, and you can watch it grow. But even more important sometimes is just understanding the industry, which now you get an understanding of the industry from the companies who do it best, because there's only like Fortune 500 companies on the stock exchange, and your investments are protected, and because there's there's the Security
An exchange commission?
Security Exchange Commission that monitors investments and making sure people are doing it the right way. So it's a safe investment most of the time.
In the regulated world.
In the regulated
right?
world.
So that's the regulated world that most people should probably start with.
Right. Okay, good.
Your investments are not entirely protected from the dollar value, but you're in a marketplace that, to the point Professor Thompson is making, is regulated. So you know that you have a fair shot as everybody else that's participating, right? There's no insider trading, there's no tips, the information is publicly available to everyone. So you have your own due diligence to do. And that's an advantage because you don't have to worry about more complex scenarios. Now, with that said, the idea is that as you go along in your path of financial investing and financial freedom, you continue to graduate, you go from your stocks to your ETF to your mutual funds. Hopefully you get into hedge funds and venture capital, and then you just ascend into you ride off into the sunset in more complex, large financial commitments, right?
Yes.
That's the goal.
Okay, and on the topic of understanding, for our viewers as well, could we define quickly, what are stocks, what are shares, ETFs, bonds, swaps, forex, etc.? Because, and especially with stocks and shares, Professor Thompson, I believe you and I have seen this in some classes. There are students who don't know the actual difference between one and the other. They say they have stocks in a company, and then they say they have shares in a company, and they don't actually know the denotation per se of the word.
Right. So there's a lot of synergy in those two words, but I'll say in the practical use, without talking about the technical use, the practical use of it. When you say you have shares, there's a quantification that comes with that, right? Which means I have 10 shares of a company. So that's an ownership interest in the company, right? You could buy different stocks, right, of different companies. But when you start talking about shares, there's a quantification that comes with that, right? I'm a shareholder. If you tell somebody you're a shareholder, the first question they should ask you is, how many shares do you have? Because there's a quantification that comes with that, right? If someone says, oh, I have some stocks, they may not think to say, how many. They don't think the quantification. They may say, what companies do you have stock in?
Ah.
What companies do you buy stock in? Or what companies do you have share in? But the whole idea of talking about shares is it gives you the requirement to quantify what that means. If you're interested in buying shares, back in the day, we talked about it earlier, if you call the broker and say, I need to buy shares in whatever company, what's the next question you're going to ask you? How many shares
do you want?
are you interested in buying? So for starters, that's what people should know, is that when you talk about shares, you definitely should start thinking about the quantification, which is the unit. Obviously, you need to know the price of each unit and decide what you want to buy. And so it makes you it gives you ownership interest. I'll go a little bit more complex, but even in that regard, there's common shares, right?
Okay.
And preferred.
That's good that you go into that, because I've always heard the term of common shares, preferred shares, and I think I heard one term I think about floating shares or something like that, but I've never known the difference. To me, it was just, okay, you got a stock and then you have shares, and that's it.
Go ahead.
So common and preferred, the idea behind the separation, and I'm not going to get too complicated for the purpose of this conversation, but common shareholders are the typical shareholders in most companies.
Okay.
Because their investment, the sole purpose of the investment, or the main purpose of the investment, is to benefit from the appreciation of the share price. Right? So you have X amount of shares, you're a common shareholder, you do have voting rights, so we'll get into rights later, because those two things play into the rights that you have. You have voting rights as a common shareholder, and the main thing you want is you're looking for the share price to appreciate. So when you sell in the future, you have benefit. Now, as a preferred shareholder, right, one of your objectives is to receive dividends. That's why preferred shareholders normally receive dividends. They're normally on the higher scale from dividend receiving from a company, as opposed to common shareholders. And their investment agreement is structured differently.
Okay.
Right? Their objective is mostly to get dividends. Right? That's what preferred shareholder, one of the main objectives. There's so many objectives, and they may not have the same rights. However, in the scale of liquidation, preferred shareholders have more rights than common shareholders. Common shareholders are the least. So if the company was liquidating and they had to sell everything off, preferred shareholders may be they may be beneficiary of getting paid dividends retroactively if that was in the agreement. Now, I have to say, since we're talking about seniority, bondholders have a high seniority than preferred shareholders, and common shareholders are pretty much at the bottom of the barrel. If any money is left, they might give the common shareholders. Common shareholders have a lot of risk. Bondholders have a very high priority because they are debt holders. They're not owners of the company's shares. They're debt holders. So to the company, the company owes them a debt. That's why their structure is a little bit different. So if you're a bondholder of a company and a common shareholder, my debt holder has a lot more rights in a liquidation event, right? So think of it as you have to pay that person off first before you get to Mr. Thompson. So
How you know I'm not a preferred shareholder?
I mean, you might be.
do me like that?
You might be.
I could be a bondholder. All right, I'm just
might
a
be.
common shareholder. Yeah, you get to Mr. Thompson.
So I want to try to keep it as basic as possible. But once we start talking about types of shares, the type of ownership structures, then you have to talk about the seniority. Then you have to talk about the rights, because a lot of these things are tied to the rights. Some people may have voting rights, some people may have certain preferences that may not exist across the board. So it's important to know that although common shareholders are the most popular things that we hear about, which is a good thing because you have access to have ownership in a company, but just know that the objective is to benefit from the appreciation of the share price, as opposed to the other type of interest, I'll say that, interest in the company, which is preferred shares or bonds or different type of debt structures. And so deciding where you fit in could be complex, and deciding where you fit in could also decide what type of investment you put in, because the share price is certainly going to be different than the bonds, right? Right. So it depends on where you fall into those dollar threshold, right? If you want to buy a bond of a company, that's definitely not going to be the same price as a share. And the liquidity side of things, right? Shareholders, common shareholders could buy and trade anytime, you know. It's a little bit more different if you try to sell the bond. And so you have a timeline horizon as a bondholder, right? You can't just go to the company tomorrow. You could try, but typically you just can't say, I want to cash in my stuff tomorrow. The shareholder could sell it very easily, seamlessly through all these technology platforms. But a bondholder has a different structure, has interest payment dates, you know. There's a different type of, and it's always mostly long term, right? You don't have a 30-day bondholder. Like, so if you're interested in day trading, you're probably not going to be day trading bonds.
Does the bondholders fluctuate as to other shares and stock? Like the stock, like today, you know how it goes. Every day it goes up and down. Does the bonds go up and down similarly or different?
No, they don't. Typically, they don't. And I have to say typically because your bond is, you buy a bond, obviously, let's say $1,000. You have a certain finite interest payment.
Okay.
So, you know, you buy the bond, the agreement is that the company is going to pay you 5% every 6 months. So every 6 months you get, you know, your percentage, which is the interest. So you technically loaning the company money. That's what's happening. Right. So all they're going to do is pay you interest at those dates that's pre-agreed upon, normally twice a year. And at the end, you get your capital back. But your main benefit is the interest payment, right? So it's different from a shareholder in that capacity, right? Now, do they have bonds that have a little bit of risk fluctuation in the interest rate payments? Yes, and that's a little bit more technical description. But typical bonds is like you have your coupon rate, you have your discount rate. It's most of those are standards, right? Your interest rate and coupon, those are standard for the most part. But they have things in the more complex scenario that adjust with inflation, right? Okay. So, you know, we had a great inflation year last year. And if you guys remember, some companies didn't do very well because of that. So some of these bonds may have those mechanisms to adjust for inflation. And that's when the interest rate may change, or your interest payments may change.
Okay, makes sense.
You know, actually on that topic of interest rates, I'd like to kind of take this now towards the matter of defining what's a bull market versus what's a bear market, because to what I've been keeping up with the news so far, you know, we're in what seems to be a bull market, right? You have a lot of investors, you have a lot of CFOs and et cetera saying, you know, sooner or later this bull market, this bubble is going to pop and everything is going to spiral out of control. And, you know, in that sense, I kind of imagine it, or I kind of think of it in the way that they've kind of put it, that, you know, you had interest rates up to about 9.1% last year. Right now, I believe it was around, last I checked, about 3%, something around there. And, you know, I kind of want to talk about how those interest rates, you know, they've affected and how they've defined the bull versus the bear markets.
Wow, that's a very complicated question. I don't know if you knew that you asked a complicated question when you asked that, but I'll try to
that's my student.
Right. Because, so defining bull and bear market could be very simple. But what you've done is incredible, because you've included a conversation about interest rates into a bull bear market definition, which tells me you're including economic changes to what determines the bull. That's a very more complex question than you think it is. So I'll start with just, all of us know, right? Bull is good. Bear is bad. You can tell by the claws, right? It's tearing everything down, right? So the bull is pretty much a sustained appreciation, you know, across major indices with the S&P 500, NASDAQ, and so on, over a period of time, over a percentage, right? So, you know, the average price going up by typically 20% is an indication of a bull market over a sustained period. And going down, also those indices going down by typically 20% is an indication of the bear market.
Okay.
And so you know that. So when they say we're in the bull market now, they're telling you the prices of those indices are
rising.
Are rising through a sustained period too. So it's evident that it's not a one-off mishap. The good news, though, is for most people that don't know, in the history of our economic system, we've had a bull market over 70% of the time, right? You know, bear markets don't happen as frequently as bull markets for whatever reason. You know, we panic when they happen because they just sound like bad news in the media, and you get worried. But typically, we normally have a bull market over 70% of the time. Now, what causes bull versus bear has a lot of economic factors. One could be interest rate, inflation rates, right? And I'll give a simplified perspective on the interest rate relationship that you made. When interest rates are low, right? So let's take a step back. Interest rate is determined by a lot of factors, right? There's a lot of policies that feed how interest rates are designed. And there's a lot of non-policy actions in the environment that also affect interest rates, right? But last year, interest rates were high, right? Because of inflation. Inflation was high because of different economic activity that happened before that. And we'll talk about leading and lagging indicators in another session. So I want to simplify that. So some economic activity happened where there was a increase in cash in our circulation, and it caused inflation. That's basically what happens. When there's inflation, the role of the people who are interested in setting the economic policy is to reduce inflation, right? You have to find ways to reduce inflation. One of the tools, one of the mechanisms, they have many mechanisms. One of the mechanisms of reducing inflation is to increase interest rates because you have to make access to cash a little bit more restricted. Because if I went to the bank now and I want to buy a house and told me the interest rate was 10%, I'm like, ooh, do I really need this house? But if I went to the bank and they said the interest rate is 1%, I said, give me 2 of those. So essentially, to control the inflow and outflow is how interest rates are managed. And now we bring in the Federal Reserve into this conversation, which is a little bit more elaborate and a little bit more detailed. We could get into that later, but they have to set the rate, and the rates that they're setting is really directed towards the banks, right? So they're setting rates because that's what the rate the bank is going to use. And whatever rate they set, the bank is going to add a premium for regular people like us. So when they increase interest rates, the banks are also going to increase interest rate. What does that mean? It means that if you deposit money, right, in a bank, the rate that you're going to be able to get back at some point, right, could be higher or lower based on that. They have to determine, should I give you on your CD X amount of percent? And if you go for a loan, it's the same scenario. Now think of it, the example I give about a house, you probably will be less likely to buy a house or a car if the interest rate was ridiculously high. It's restricting you from spending money, right? Think of it. But let's take off, our one-on-one away from this. Let's talk about a business owner in Publix, right? If they want to buy vehicles in their fleet, if the interest rate is high, they may have to reconsider other options, right? And if they didn't, they could incur the cost, but they'll pass it along to people like us. Yeah. Because they're now paying a high interest rate. What happens when they bring the goods prices have to be higher. So when you go to Publix and you say there's an inflation, you say, well, the prices of a can of whatever is now twice the price. Yes, because the person providing you the service is incurring additional costs. Right. So there's an economic system around how interest rates, especially the Federal Reserve side, dictates a lot of things around pricing. And it also dictates the stock market, because if the interest rates are low, you're going to have more money to invest. You have more access to capital to invest. You're actually more interested in investing. If there's and it's a cycle, right? There's more cash available, you're going to want to invest more or spend more. But if there's less cash available through increased interest rate, you're not going to spend it. They're going to restrict spending. They're going to slow down spending. And so if you have to put it in a bubble, right? Yes, there's a correlation between the interest rates and the bear market, because we saw that during the pandemic, right? When there was, when there was a lot of more stimulus happening, and interest rate was like what, at 3% or some low number over that period of time. People were spending money.
Yep.
People were spending, and that caused the inflation that we're in today. So there's a relationship between interest rate and bear market, and the prices of shares also started to rise because people were buying shares. So it helped build up the pricing. And so I don't want to get too complicated, but there's a direct relation. Your question was very good.
Excellent.
It's more complicated than
Excellent.
you probably. I didn't want to take too much time, but it's a little bit more complex because you have to first define what affects bull and bear market, and then you have to define the policies, economic policies that feed into that.
I wanted to, I know you didn't want to get this deep into this particular conversation, but I just want you to get the power of the Federal Reserve. I've been hearing about them, everybody, from Alan Greenspan, that's before your time.
No, that was my time, actually.
And their power. And I just want to just go a little deeper, only because, as we talked about early, many students come from other countries. They come from other environments that are controlled totally different. And so the Federal Reserve, is it unique to America? Or is it, or what is the function it serves? I don't want to bypass it. The true function of the Federal Reserve when it comes in our economy, and why is it so important making America?
The Federal Reserve, as defined, is not completely unique to America.
Okay.
But you could make the argument that some of the actions could be unique to America.
Okay.
And we have a very, very strong structure at the Federal Reserve. You have different members, and you have the chairman, Alan Greenspan, one of the most famous ones. I think he did some incredible things when he was there. But think of it as the Federal Reserve is there to set monetary policy. The government is there to set fiscal policies. It's two different responsibilities. People think it's one and the same, as if to say the Federal Reserve is part of the government, or what they do is completely different from what a government can do, right? Obviously, they work together, right? But if the government wanted to increase the flow of cash, the fiscal policy that they would implement would be very different from if the Federal Reserve wants to increase the inflow of cash, right? If they wanted to expand or what they say, speed up the growth of the economic environment. So the Federal Reserve's goal is really to manage just not monetary policy from the standpoint of interest rates, but the relationship with all the banks. All the banks have to be cohesive, right?
Right.
And so to do that, you need a structure, an overseer structure that gives policies around what banks can also do, or controls or restricts what they can and cannot do. Because if a bank needs cash flow, where do they go? They can't knock on your door and say, hey, Mr. Thompson, loan me $100.
Right.
They have to go to the Federal Reserve,
Right.
right? And then the Federal Reserve could loan them the money at the interest rate that's published, right? And when they have that money is when they could loan you. Because when you deposit money in the bank, you realize that, again, I won't get too detailed, but just for the viewers, that's what's being loaned out also, right?
Okay, right.
Okay, let's go for it then, right?
Right, okay.
Let's get into the weeds, right?
All right.
You deposit $1 in the bank, right? The bank has $1 from you, but they could loan him $2. The extra $1, where does that come from, right? Those are the relationships that we don't see. It's like very, very invisible to the casual consumer.
Right.
But those are the benefits of the Federal Reserve to implement these policies. Where now the bank has $2, it could loan somebody. They could loan somebody extra. He could loan them $2 instead. But then, if you come tomorrow, you still have to get your your dollar if you wanted it, right? So that relationship of managing just the monetary cycle is where the Federal Reserve comes in, and that's what they do. I know there's a feeling that they kind of control the economic system entirely. They don't really have 100% responsibility. There's a part of it as the government, which is the fiscal policy, and then we could get into how they manage those, whether it's treasury bills, buying assets, investments, selling investments. So both roles are completely different, but the Federal Reserve is one of the critical points of implementing monetary policy in the United States. And there's so much they do that we probably cannot. We could do a whole session on that alone.
Oh, yeah.
So I don't know if I
No,
answered
you
your
answered
question.
my question. We can get very deep in it because
Right.
at some point, I want to know the future of banks.
The future of banks.
The future,
Wow.
because if you go to Bitcoin and cryptocurrency, they think it should come to an end. They think why do you need it, right? So I wanna at some point, not today necessarily, because we have a few more of these. I really want to understand where's the future of bank, because sometimes we put the interest rate at a bank is non-existent almost when you put things into savings and to checking accounts. It's almost non-existent. Do I put it under a mattress? Do I, I know crypto is, so we can get into what's the future of banking is something I definitely want to have a conversation about.
I think our economic system today, as is designed, is going to always need a banking system.
Okay.
Because banks don't just function as consumer service providers. They also serve a purpose in the insurance world.
Oh, really?
Right. So we see them, from an individual, you see them as a service provider. I deposit my money, cash my check, etc. But they also serve as key participant in insurance and commercial lending, like those other things apart from the average Joe. We may buy crypto. We may choose to go straight to crypto, and you don't want to deal with the banks. But if you wanted to buy a 50 apartment building and 50 unit apartment building, or you want to build it from scratch, at some point you may need some commercial loans. Right? So the banks serve a purpose in the commercial entity area. Even if we get to a future where we don't need them for the individual transactional level of money exchange, monetary exchange, I think we're still, and again, this is just an assumption on my part, a prediction. I could be wrong or right, but just based on the fundamentals, that the commercial side still needs the banking system for now, at least for now.
That's it's a good point, and as Professor Thompson mentioned, I'll also leave this for a future episode because, I personally didn't know the difference between, like a fiscal policy and then the actual monetary policies, and it's interesting to me because not too long ago we saw the fall of, I believe it was South Valley Bank around California.
Yes.
And I believe there was another one too. There were about 2 or 3 banks that fell consecutively, and that sent the entire banking sector throughout the stock market and just in general in quite a panic.
Right.
You saw a lot of prices decrease, a lot of shares from companies fall. I think the most recent one was Bancorp, which I believe today they saw about a 20% drop in their shares. And it's interesting to see how the government deals with it, because from the average consumer, it looks kind of unfair if the government bails them out of, billions of dollars of debt just wiped out. But in the corporal sense, it's like, well, what is the alternative? If they weren't bailed out, how would that get passed on to the consumer?
Exactly.
So I'll leave it for the future, but because I know it's a massive topic to dive into.
Very, very incredible point. Incredible questions.
That's my student.
Yeah.
No, okay.
And when you hear that, you will never hear that statement the same ever again. When people say, you're bailing out the banks. Are you bailing out the banks? Remember, FDIC protects the customer deposits also.
Right.
And wait, when a bank is bailed out, we just had a conversation about common shareholders, right? Do you realize that, assuming the bank were not bailed out, a lot of common shareholders, some maybe institutions, some people, regular people, will lose their investments. So when we say bailing out a bank, I think in another conversation, we'll define exactly what that means. By the way, what happened to Silicon Valley Bank could happen to almost any bank. A bank rush could victimize almost any bank. When all your customers come to you for their money at the same time, when we just had this whole conversation about they only hold a portion of the deposits because of the, there's a requirement that you hold X number of deposit, any bank could be victims of that because banks also have to invest. They can't just put your money in the safe and just sit on it. They have to invest in different assets so they could get return, right? They have to invest and they have to do loans to get interest. That's how banks function. So the idea of Silicon Valley Bank's scenario and what happened to them subsequently, whether you want to call it the government bailing them out or, in this case they were acquired, but the idea is that the people who deposited money have to be FDIC insured, right? So there's a protection there. But then the shareholders, who are also regular people, if the banks goes belly up, they lose their investment. That also has an impact in our economic system. We just had a whole conversation, right?
Yep.
And so that's the idea. But I'm glad we'll have that. We'll dive into that weed at some point. But that's a very good analogy you just made.
I know there's a lot to dive into when it comes to the financial world. A lot of my classes here, they've been negotiation, they've been supply chain management, which I know is one of the economic events that leads to inflation and the bottlenecks on what's available and what's not available. And it's a topic that from my perspective, from my generation, Gen Z, not all of us really get to listen to or even get to learn about this, right? A lot of my generation, we learn about something simple. We hear, okay, you have a bank account, you have a checkings account, and then you have a credit account. But then we don't really learn all the macro and microeconomic factors that play into it. We don't learn how the Australian Reserve increasing or decreasing their rates affects the American dollar, or how the European Union Bank, how their rates affect our money, etc.
You get into exchange rates now.
There's a lot to
unpack.
So if I may, and we can start wrapping it up, because I know we've taken it a lot, right? We've kind of delved into a few topics that in future episodes for our audience, we'll dive into real estate, exchange rates, we'll dive into forex, we'll dive into stocks, options, basic different things, or not so much basic as they are very complicated. They're very very affected by different matters. We'll cover those in future episodes. So what would you say, as a final topic, is a good mentality, a very leveled mentality to have in one's head, not only for a beginner at investing or at building one's own personal wealth, but also when you get to a more professional level? Because I've seen and I've heard of professional investors who very, very easily, their whole fortune just gets wiped out. And it kind of, postulates the question, how did this massive person who managed to build such massive wealth just get wiped out very quickly?
Right. So professional investors have a different problem than me and you, right? All of us here, right? because they're managing accounts, right? So the type of risk they take impacts their portfolio, and they could get wiped out if they're taking too much risk. But also, as individual people, also have to establish what our risk appetite and our risk tolerance is, right? No matter what level of investment we want to make. I think that's important. But think of this. Right? You're saying habits, right? First, you have to establish the environment that you're in. The environment that you're in is designed to make you or ask you to spend money. By the time we leave here today, by the time we go to bed, we would have come across at least 40 commercials asking us to spend money. We're not going to come across one that's asking us to invest. So you have to establish that criteria of your environment first. This is what your environment is asking you to do. What do you want to do? Right?
Okay.
Because that's where the discipline, we talked about that early on, the discipline factor is, okay, the habits is A, discipline. Establish the environment you're in. Your environment is going to ask you to spend money. They're going to, sell you things, and you have to decide what's important. Because once you make that decision of what's important, If you decide that investing is important, then now you could decide a portion of your available cash should go into investing, and then we could get all the options of investing, in line and line them up, and you could select from there. But it's a decision, right? You will be bombarded with commercials between now and before you go to bed, but you're not going to get a commercial saying, "Hey, invest in this." Have you ever seen a commercial to invest in a share?
No, never have. I've seen so many Starbucks and Dunkin' Donuts.
Right.
That's such a great point.
But you're not going to see that before you go to bed tonight on the TV, right? So you as individuals have to make a decision. Who do you want to be? You want to be an investor, or you want to be a spender, a customer? And once you make that decision, everything else is available to you to continue your journey. I think that's the biggest part of, at least for me, the mentality around money. And we just talked about it earlier. If we knew 20 years ago what we knew now, because our psychology was different, obviously, we would have amassed a larger fortune just because of time. And we didn't get into the time effect and compounding and the benefits of compounding. We'll get to that into another episode. But just the decision, make a decision of who you are.
Yeah.
You're a spender or you're an investor. And you can make that decision and use your discipline to decide how you want to move.
Professor, any final thoughts, any closing thoughts?
Well, I want the audience to know that we touched on a lot of areas. And we're just having a general conversation. And as you said, there's going to be future episodes. And those episodes are going to talk about different investment vehicles and risk versus reward and building a portfolio, market cycles, behavior bias, and investor psychology. We live in a digital age, AI, how does this affect everything? Retirement planning, real estate, and certain skills and habits. This is the conversation that needs to be had. There's no quick answer. We are all going to be, we're going to all do it differently. We're all going to, but I will tell you right now, there's many people that are listening to this that aren't involved at all.
Right.
At all. It's not even about the complication. It's zero. They're talking, what the hell are they talking about? Bank. Look at my mattress. So that's why it's important to have these conversations so that we begin that conversation that sticks in one's head. I mean, when I leave today, damn, they want me to buy something.
Right.
They want me to buy something. Where are they asking me to invest? When are they, asking me to build wealth, to become into partnerships, right? Where do I want to spend my time? And so I'm looking forward to continued episodes where we can share as much as we can have. As we go forward, the episodes are going to be probably a little bit more defined, quicker, to the point, and so that you get an education. And it's a great way to start for those people leaving a university in terms of going out into the world. Scary out there, still is. And but we want to arm you. That's what education is about. Arm you with as much information to help you succeed. And we would be negligent if this conversation did not happen.
Right. Right. Absolutely.
I can wholeheartedly agree with what you've said, Professor Yinka. I can wholeheartedly agree with what you've said as well. Thank you both for your time in being here. Thank you both for all the knowledge and for being willing to impart this amount of knowledge onto the younger generation. And to our audience out there, thank you for tuning in. As previously mentioned, in the future we'll have episodes more detailed into real estate, forex, stocks, and so forth. And we'll hope to see you again.